We're happy to have Sasha Indarte present consumption wedges, measuring and diagnosing distortions. This will be followed by a discussion from Ricardo Perez-Truglia from UCLA.
First, I'd like to thank the organizers for including our paper in the program. This is joint with Ulrika Malmendier, Ray Klunder, and Michael Stepner. So financial constraints are the primary friction used to explain the consumption decisions of households with low liquid wealth. A key reason for this is that there's a large body of empirical evidence that has documented substantial deviations in consumption behavior, especially from the permanent income hypothesis, especially among households with low liquid wealth. This includes things like the insensitivity of consumption to persistent income shocks, as well as the excess sensitivity of consumption to transitory income shocks. That is, high marginal propensities to consume, or MPCs. Now, high MPCs, there's more than one way to generate them. Financial constraints are not the only way, even though this has been the dominant theoretical explanation. And recently, there's been growing interest in other distortions, both frictions and behavioral preferences, that can also give rise to high MPCs. Now, intertemporal choice, it's important to understand. It's foundational for both macroeconomics and asset pricing. And it turns out these different models of that can all generate high MPCs, they have very different predictions for household behavior. You can, for example, Peter Max had chosen work with Sean Lee, that when you add present bias to a standard macro model, specifically a heterogeneous agents and Keynesian model, which features financial constraints, you get significant amplification of both monetary and fiscal policy. So ultimately, you can get very different macroeconomic transmission, different asset pricing dynamics, depending on the model of distortion that you think is appropriate. Now, because these predictions differ so much, it's important for theory and policy ultimately to have as much empirical evidence as possible to discipline our understanding of what drives intertemporal choice, that is the consumption savings decisions of households. And the goal of our paper is to provide such evidence on what distortions are influencing this decision, and also a new way to quantify how much and tell us something about the nature of these distortions. So to answer this question, we use a new approach. Specifically, we are going to focus on what we call consumption wedges. These are wedges between people's actual consumption and their hypothetical frictionless consumption. Now, in order to measure this wedge, we show that it's actually possible to use a common set of sufficient statistics to calculate these consumption wedges. A key input to that is going to be consumers' economic expectations. Now, once we have these wedges, we can look at their distribution, look at their properties, look at their correlates, look at their sign, things like that. And that's going to be instructive because alternative models of distortions have different predictions for these properties of the wedge. So the wedges, they can serve as a diagnostic for models. Now, we operationalize this framework using a new data set where we link a survey of consumers' economic expectations to their financial account transaction data. The population we're going to study, it's not going to be a representative sample. It's going to be a group of consumers from the US. It's going to skew most notably towards middle income, but low liquidity, very low liquid wealth households. Now, I'll briefly summarize our main takeaways from our analysis. So we find, first of all, that wedges are large. The median household in our sample has a wedge that is about 52% of their frictionless consumption. So this tells us that distortions are an important determinant of consumers' consumption savings decision. The second takeaway we have relates to the signs of the wedges. So we find a mix of positive and negative wedges. And what's striking about that is that positive wedges, which correspond to overconsumption, that is consuming more than your hypothetical frictionless consumption, overconsumption can't be generated by financial constraints. Financial constraints, they can only distort your consumption downwards. So this immediately tells us that financial constraints are insufficient to rationalize people's empirical consumption choices given their beliefs. Now, we point to two promising directions for future work in terms of theoretical frameworks that can replicate this mix of positive and negative wedges. One possibility is to combine present bias, which can help generate positive wedges, with financial constraints. Another possible explanation is consumer inertia. So this could be things like consumption adjustment costs or particular forms of bounded rationality. Now, I'll briefly try and highlight a couple things that are novel in this paper relative to the existing literature. So, one of the things that we add to the literature on what determines consumption is we provide a new diagnostic tool. We demonstrate its application. We draw qualitative conclusions about models that are able versus unable to match the data. But the moments that we document, they are also something that you can take to a quantitative structural model and help to not only discriminate between different models of distortions, but also to calibrate your model of present bias or calibrate your model of consumer inertia. Another contribution that we make in this paper is to essentially build a bridge between the big literature on consumer expectations and a macro literature that's focused on quantifying frictions. So, one of the things that's going to be new here in our accounting framework, our wedge measurement procedure, is we're going to use subjective expectations data. This means we're not going to have to rely on an assumption of full information rational expectations, FIRE, in order to be able to measure wedges, which has been what's done in the past. Now, what's important about this, why does this matter? Well, when you observe some behavior that appears consistent with constrained optimization, there's some belief story that can rationalize it. So these prior papers that were measuring wedges, assuming full information rational expectation, one of their limitations is that it's hard to say for sure if that wedge that's being measured, is this reflecting truly frictions, constraints, things like that? Or maybe deviations from FIRE. Now, because we have the beliefs data, this is going to make it possible to account for their beliefs, whether they're consistent with FIRE or not. And it's going to allow us to isolate the influence of either frictions or behavioral preferences on households' consumption decisions. All right, so before I show you any data and show you any graphs of wedges, I'm first going to introduce our framework. To start, we posit a frictionless benchmark. So this is going to be a toy model. It's not going to be a good approximation of reality. It's going to serve a purpose for measurement, for acting as a benchmark. Now, what is our frictionless benchmark exactly? So it's going to be the class of models with three characteristics. So the first is that consumers have what we call standard preferences. Most importantly, that's going to mean time consistent and time separable. So no present bias, no habit. It's also in this class going to be models where budget constraints and Euler equations are necessary conditions for optimality. They need not be sufficient, just necessary. And then finally, we're going to be very flexible when it comes to beliefs. We're going to put a tilde over our expectations, and this is going to denote subjective beliefs, which can differ from full information rational expectations. Now, in this class of models, consumption, frictionless consumption, I should say, is going to obey the budget constraint, and it's also going to obey the Euler equation. What we can then do is log linearize these, forward iterate them, combine them, and we get a log linear expression for frictionless consumption that's basically going to be some fraction of people's permanent income. So what exactly does that look like? And one thing I'll point out, I'm going to be dividing by income in a few equations here. You're going to see in a little bit whether I divide by income or not. It's not going to matter for what I'm going to show you, but I'm just going to call, even when I have log consumption over income, I'm going to call that consumption. So frictionless consumption is a log linear function of first an intercept term, which is mainly related to your time discount factor, your beta. Then it's also going to depend on your current wealth. So how much wealth do you have relative to your income? And it's also going to depend on your expected lifetime income going forward. Now, your income going forward, that's going to depend on the term structure of your beliefs about a couple key objects: your nominal income growth, inflation rates, and returns that you expect on your portfolio. Now, in the way that we write this up in the paper, just for simplicity, we formalize this as there's a single asset. You can, it's straightforward to generalize to multiple assets. What's going to happen is in this equation, the R that you have here, that should be the return on the household's portfolio, which could potentially have many assets in there. So one way to see that is if you have a bunch of different assets, you have Euler equations for each asset. You can do a portfolio weighted sum, and you're going to get that interest rate term. That's what you're going to want to plug in to this equation here. So we know households' beliefs and the term structure of those beliefs, and we know their current wealth. We can infer what their frictionless consumption would be. And these parameters that we have here as well. So what's under the hood there? So our choice of approximation points, we're going to do a bunch of sensitivity analysis with respect to that. And then also 2 preference parameters, your beta and the gamma. Now, because we're doing this first order log linear interpretation, the gamma, we should mainly think of this as having the interpretation of an inverse intertemporal elasticity of substitution rather than risk aversion, because they're really just trading off consumption at different points in time. So once we are able to measure for a person their hypothetical frictionless consumption, we can contrast it with their actual consumption. And that's going to be the wedges that we measure. Now, what exactly do these wedges tell us? What do they correspond to? Oh, and sorry, I should also mention uh, we need the Euler equation and budget constraint to be necessary for optimality. You can add labor, you can add housing, you can add default, you can add a lot of other decisions. That's not going to change the formula that we have. So it's a pretty robust formula. Now, what do these wedges measure and what do they correspond to? Well, it's helpful, I think, to think about alternative models. So, for example, if you have a model with borrowing constraints, that puts a wedge in your Euler equation. It puts this Lagrange multiplier in there, and it's going to distort your consumption downwards if the constraint is binding. If it's not binding, your consumption would coincide with what you would have in the frictionless world. Present bias, on the other hand, it distorts your consumption upwards relative to this frictionless benchmark where we have time-consistent preferences. And lastly, inertia, what can that do? So again, inertia, that could come from consumption adjustment costs, could come from habit, forms of bounded rationality. With inertia, you could potentially get either positive or negative wedges. One way to see this, imagine someone gets an income shock. Now, if it's a positive income shock, someone who is inertial, they might not fully increase their consumption as much as they would if they did not exhibit inertia. So that person could end up under-consuming when they have a positive income shock. Now, with negative income shocks, you can get the reverse. So you lose income, it's difficult to adjust, there's cost to moving, cost to pulling your kids out of school and moving them to a new neighborhood and all of that. And so you keep your consumption higher than you would, and you end up over-consuming and under saving at that point in time. So one of the first predictions that we get are some pretty stark predictions about the signs of wedges. And there's other things that we can do. Some things I'll show you in this paper. We're going to correlate these wedges with other measures of people's behavior, things that we might think are correlated with financial constraints, correlated with consumption adjustment costs. Something that future work could do would be to also look at how these wedges react to shocks as well. All right, so now I'll tell you about the data that we use to measure these wedges. We partner with a fintech company called Earnin. They provide a financial service, essentially allowing people to get access to their earnings before payday. They do not officially charge an interest rate. And actually, in the period where we were studying them, people could give voluntary tips to thank them for the service. And people willingly paid like 100% to 200% APR as a thank you for this service. But this would typically be tipping like $2 to $3 on borrowing $50 for 10 days, things like that. So you get really high APRs if you calculate it that way. Now, the users, in order to use this service, they have to link their main bank account that is affiliated with their primary source of income. They link their checking, their savings, and we're going to focus on people that have debit or credit links, so we can also see what they're spending money on as well. And from them, we're going to get this transactions data. So basically, imagine I have a bird's eye view into your bank account. I see your paychecks coming in. I see that you spent $5 at Starbucks in this zip code with this timestamp, things like that. And that's all going to be de-identified. Now, we then worked with this company to help administer a survey. Our first wave had about 10,000 respondents, and we did a couple more waves. We tried to recontact people. This is my first survey, so I learned that recontacting people is really hard. So we're only going to get about 160 usable observations from that recontacting. And then we did repeated cross-section, so reaching out to the same pool, but mostly getting a lot of new people. In a third wave, from that, we're going to get about 2,000 to 3,000 usable observations. And our 10,000 is going to shrink to about 4,000 after we do all our data quality controls, like dropping people that say 1,000,000% inflation is what they expect and things like that. Now, what do? We solicit expectations over inflation, nominal interest rates. We ask about both what essentially your expected marginal return for a marginal dollar of savings, and also if you were to borrow, what rate would you expect to pay? We also ask some additional questions about balance sheets because we mostly see flows, not stocks. So we ask, for example, how much debt do you have in total, things like that to help us measure their wealth accurately. And for timing, we ran our first wave in fall of 2022, and then our later waves in July of 2024, and then November 2024. Now, I'll highlight a couple characteristics about our sample. I think the main important ways in which they differ from the broader population. So it's a fairly middle income population. Their annual income is about $37,000. That's the median person. Now, this is after tax for them. The age, so the interquartile range for this sample, it skews quite young. It's about 31 to 43. And it's also overwhelmingly female. We have about 68% of our sample are women. Now, the first graph I have on the left here, this is a histogram where we basically take people based on their income after tax, and then we assign them their percentile in the after tax income distribution. If we were perfectly representative, you would expect a flat line at 2% here. But instead, we see that we're missing mass at the high end of the income distribution, also at the low end, and we have overrepresentation among people in the middle of the income distribution. So a middle income person is who's in our sample. But when it comes to liquid wealth, on the other hand, our sample skews very strongly towards households with low liquidity. About 61% of them have they report having less than $500 in liquid assets overall. So bank account and also including brokerage account, things like that too. Now, their expectations, I want to show you that their expectations overall seemed fairly reasonable. So most of our samples coming from 2022. If you remember at that time, a lot of people just lived through about 8 to 9 percentage points of inflation. Many of these folks for the first time in their life. And their average forecast going forward was about 8.7%. So they overshot it a little bit, but not a ridiculous number given what they had recently experienced. For income growth, they were generally forecasting about 5 percentage points. For interest on savings, maybe a little optimistic, forecasting 3.5%. And then also maybe a little optimistic on borrowing, forecasting about 14.5%, which is a bit on the low end for credit card APRs at this time. All right, so that is our sample. Now, there's some assumptions that in the shorter format I won't be able to talk about in detail, but I'll point them out and we can discuss them further in the Q&A if anyone cares to do so. So we have to make some assumptions to deal with durables and non-durables. The gist of what we do is we measure people's non-durable expenditures, and then we make this Cobb-Douglas functional form assumption about how these things enter your utility function. And that's going to allow us then to basically scale up your non-durable spending to get your total consumption. We pick our approximation points as being just medians in our sample. We're going to take some pretty standard values for preferences. We're going to assume homogeneous preferences, but we have some results that suggest that preference heterogeneity is unlikely to be driving the wedges I'm about to show you. We have to assume that there's no measurement error. I'll show you some robustness that takes this concern a bit more seriously. And then also, we need to deal with this term structure of the beliefs here. So we didn't want to make too taxing of a survey. We have 1 year ahead expectations for most of our beliefs. We have a 3 year ahead expectation as well for inflation. And I think I'm going to have to skip some of the details on how we do this imputation, but if anyone's curious, happy to chat more about it. All right, so on the left, I've taken the absolute value of our wedges. So that's just to assess, what's the typical magnitude, and then we're just looking at the raw wedges on the right here. So starting with the left, we see that the modal wedge is large. It's around 50 percentage points, and our median wedge ends up being about 50 percentage points. So this is saying that the typical person in our sample, their consumption is extremely distorted away from what they would choose in a frictionless world. So whatever is distorting their consumption is an important determinant of their consumption. Now, looking at the histogram of the raw wedges, we see that the bulk of people do have a negative wedge. So that's something that could be explained by borrowing constraints, by financial constraints. But those are on their own are not going to be able to generate the 25% of folks that have positive wedges, which we see here. So we see non-trivial, in fact, a large amount of people over-consuming. And this is telling us that you need something beyond financial constraints to explain people's consumption behavior. Now, I'll show you a little bit of robustness to, I think our two main concerns really are measurement error and the calibration choices that we make. Things like our choice of discount factor, our approximation points, the factor that we use to scale from non-durable to overall consumption. So we do a sensitivity analysis. We basically vary these things to different extreme values. And we look at how those moments from the histograms that we were focusing on, how they're affected. And generally, we find that the numbers that we're getting they tend, if anything, be on the conservative side. And at worst, we still get roughly similar orders of magnitude, for example. So we still tend to see about 25%, a quarter of people over consuming, and typical wedges that are around 40 to 50 percentage points. Now, for measurement error, there's three main things that we're doing on this front. So the first thing, and where should we worry about measurement error? So people might round some of the numbers that they give us. Also, transactions data, while it's one of the best things you could hope to have to try and measure people's consumption, it can be noisy, it's messy to clean. And also, there could even be things like, what if there's a credit card we don't observe? What if there is a bank account receiving income that we don't observe? So that's a standard challenge that you have to grapple with this kinds of data. Now, we do the usual quality control measures to try and ensure that we're looking at a sample of people who were plausibly getting a complete picture of their economic activity. But for additional robustness, we do a few things. So the first is we drop people that are more likely to have higher measurement error to essentially see, are they potentially driving our results? And do we end up still seeing similar results? So this includes dropping people that received unemployment insurance income because they might not have been, we asked them to forecast their total economic income, but that might not have occurred. That might have been harder if part of their economic income is unemployment insurance. We also dropped people, for example, that rounded their inflation expectations to increments of 5. The idea being that if you say 7 or something like that, you're maybe, not shading your true beliefs as much. And also dropping people that have, say, a lot of cash or a lot of durable expenditure, dropping people that we tag as low financial literacy based on their performance on a couple test questions. And we end up getting similar numbers there. Another thing that we do, we group people using a generalization of k-means clustering based on wealth of demographic and other economic characteristics. And so we bin people with their peers. We then average their inputs to the wedge. And the idea is that that should help remove some of the measurement error. And then we recalculate the wedges. We still see similar properties for our distribution of wedges. And then more of a brute force thing, we just add a bunch of noise, and it would take a really large measurement error in people's beliefs and consumption and income in order to change the two key statistics that we're measuring for our distribution. All right. Now, I want to show you a few correlates with these wedges. So the first is a correlation with people's hypothetical behavior. We asked people, if you expected inflation to be higher in the coming year, would you today save more, save less, or save the same? And we see that our positive wedge folks, our over consumers, they are more likely to report that they would save less in response to this hypothetical shock. So in this sense, we're seeing like a internal consistency between what the wedge is saying about their behavior and their own self-reported anticipated behavior about how they would react to inflation. Now, we also compare it to their actual behavior. So we use the stimulus checks that people received in March of 2021. We essentially try to measure a person-level MPC by comparing the excess spending that they have at the time of receiving the check relative to what they're doing before and after at the same time of year. And we see that these MPCs are also positively correlated with overconsumption in particular. And the fact that it's not V-shaped, which you might have expected if borrowing constraints are really driving some of the extreme negative wedges, the fact that it's not V-shaped suggests it's also a point against financial constraints explaining what's going on. So this suggests that whatever is behind high marginal propensities to consume, it's likely related to something like present bias or inertia that generates overconsumption. Now, we can also correlate our wedges with financial distress. One of the few ones where we get a V shape here is people that report having unmanageable amounts of debt. That can be our folks with either extremely large or extremely small, that is large negative wedges. And then also reporting high anxiety with finances. That's also positively associated with the wedge as well. So our positive wedge people, they tend to report being more financially distressed. We also look at some objective measures of financial distress, like liquid wealth, the amount that they have in their bank accounts, and that's also positively correlated as well. Now, another thing that we did, kind of motivated by the Kaplan-Violante literature that studies these wealthy hand-to-mouth households that become an important building block in modern macroeconomic models, was to compare people that have mortgages versus those that don't. The idea being that that's probably a good tag for "Are you a homeowner?" And we see that our mortgage folks, very few of them overconsume. It's only about 6% of them, and they're driving the bulk of our very extreme negative wedges. Whereas the folks that do not have a mortgage, they are driving the bulk of our overconsumption here as well. So this is suggesting that maybe for homeowners, the Kaplan-Violante model of wealthy hand to mouth, that might be a pretty good approximation for those folks, but our non-homeowners, well, it might be something like present bias or inertia that's first order in driving their behavior. All right, so to summarize, in this paper, we identify significant scope for behavioral preferences or frictions beyond financial constraints to explain the consumption decisions of low liquidity households. We use this novel wedge measurement approach. And while it's ideal to have transactions data to be able to do this, this is also something that could be implemented simply with a survey, even if you're just asking people about their consumption as well. We've been talking with a few folks, I guess maybe I might be too premature to say anything, but there might be some publicly available surveys that might include our questions in the near future that would make it possible to calculate this for a large representative panel as well. Now, what advice do we have for macro and household finance going forward? It's important to consider frictions other than financial constraints. Promising alternative models combine financial constraints with present bias or feature consumer inertia. And with that, I'll stop here, and thanks in advance to Ricardo for discussing.
Ricardo Perez-Truglia from UCLA Anderson will discuss the paper.
Hello, everyone. I'm Ricardo. I'm a behavioral economist at UCLA Anderson. I don't come super often to finance conferences, but when I do, I'm reminded of how rich you guys are. The venue is so nice. You have real food for lunch and not some dry sandwich or something. So given that I'm going to discuss a paper about misoptimization, maybe I have to begin by acknowledging that maybe I misoptimized myself. I should have done less behavioral economics and a bit more of behavioral finance. Okay, so in case there is anyone in the room who is going to be a referee for this paper, I want to start by remarking how excited about this paper and give you some reasons why you should be very excited as well. I think there is a lot to love about the paper. The first thing that stood out to me, because I'm a data nerd, is that the data is pretty cool. So what they do is they merge survey data where they elicit people's expectations and wealth and things like that. But on top of that, they can merge it at the individual level with the transaction data. So they can see each bank transactions where they can see, hey, this person spent this much on this good that is durable or not, and so on and so forth. But they also can see the balances and they can see the earnings and so on and so forth. So having these two together is fairly rare in the literature, and there is a simple reason for that, which is that you have to go and convince a company to give you the data and let you run research. My best guess is that the company doesn't really have anything super fundamental to learn from this research. They're doing it out of altruism or whatever. That would be my best guess, and then pitching to a company that they should let you play around with the data and give you access and let you recruit service and so on and so forth is something that is really tough, and I think that they need to be acknowledged for pulling that off. The second reason why I think you should love this paper is that methodologically, it's providing a new sufficient statistic approach to measure these consumption wedges that in particular makes the point that you can do this at the individual level, and that turns out to be pretty important when you look at the results and the interpretation of the evidence. I will talk about that a bit later. And they also do this thing where they use this approach based on the Euler equation that doesn't rely on the full information rational expectations assumption, which I think they are underselling or underexploiting in that they could do more. So if you think about it, what they are saying is I'm taking people's beliefs or expectations about the future as given. They can be crazy. I don't mind about that. And I'm seeing relative to those expectations, are you over or under consuming? Okay. So if you think about whether people over or under consume, the way in which they think about this is like relative to what they should be doing to see whether there are any constraints or behavioral biases that led them to consume more or less. But if you think more about the social planner or the government, there is another friction that you care about, which is the misperceptions or the mis-expectations. So it could be the case that a person has this crazy expectation that they will earn a lot of money in the future, and they're consuming a lot because they have that expectation. According to their wedge right now, that's going to be totally fine. It's not going to count as overconsumption. But in reality, as a social planner, we know that that's overconsumption. So again, I understand that their approach makes total sense in the context of the question that they're analyzing, but I don't know if in a future paper you may want to also try to say something about like the misoptimization based on the missed expectations. Okay, finally, and most importantly, they also get some interesting insights that may be useful for a broad audience in household finance and macroeconomics and so on and so forth. There are lots of interesting findings. I will focus on like the two big findings that I think are more important. The first one is making the point that the average wedges, which is the approach that the literature was taking up to now, is missing a lot of useful information. That even if the average person or people on average underconsume by 10%, what's really going on is that you have some people who are underconsuming by 50% and some people who are overconsuming by 20%. So when you average them out, it looks like they only quote unquote underconsume by 10%, but in reality, there is a lot more going on. Actually, if you take their estimates as face value, only 9% of the people in their sample are actually close to optimal consumption, defined as within 10% of the optimal consumption. So that's the exciting finding, is that a little bit too behavioral, if you wish. It's like not saying that, okay, some people are making mistakes. What they're trying to claim is like 92% of people are making this, the vast majority of people are either over or under consuming. And the second important point, which I thought that it was very well stressed in the presentation, is that overconsumption is a significant problem, and maybe we need to explore that a bit more and not only focus on the traditional financial frictions that lead to underconsumption. So that's another thing that you get from measuring the wedges at the individual level. You would totally miss that out if you were looking at the average, at the overall wage or the average wage in the population. Okay, so I understand this is a preliminary work and they're probably thinking about how to polish different parts of the paper and expand it and so on and so forth. So I wanted to use the rest of my time to maybe suggest some growth opportunities, some parts of the paper that I think could be improved or expanded. So if you think about the main contribution of the paper, it's not really to document that frictions exist, because that's something that we know from a large literature with experimental evidence, quasi-experimental evidence showing that people don't optimize all the time. The main contribution, at least in my opinion, seems to be that they're able to quantify these frictions for a large sample of people and thinking about all frictions at the same time, not zooming in into a particular shock. Hey, what happens when people receive unemployment insurance, or what happens when this happens, and so on and so forth. Let's try to take a step back and think about like frictions more generally. So how large they are, how heterogeneous they are, and what are the correlates? Which groups of the population have higher frictions or friction in one direction versus the other, and what can that teach us about the sources of those frictions? Is it because of liquidity constraints? Is it because of self-control, and so on and so forth? So some dimensions that were a bit dismissed and are important in the paper, like they won't affect the results too much, that I wanted to push back a little bit on, are three. So one is the external validity. The second one is the measurement error. And the third one is the preference heterogeneity. And, in the paper, I wasn't entirely persuaded that these things don't matter. I think that probably they do matter a bit more than what the authors think. So, maybe I'm wrong and they don't matter at all. And maybe what they can do is they can try to figure out ways of showing more persuasively that these things don't really matter, or maybe take this other approach, which is, well, these are important if you want to get the measurement right. Again, this is a paper about measurement. So maybe the approach should be, okay, let's fully embrace that these things are going on, and let's try to adjust our estimates, shrink our distribution to try to account for these factors. And you could do that in a data-driven way. And given that you have this rich data with survey and transaction data, it looks to me that you should have a lot of stuff to do in these dimensions. So let me start with external validity. I looked up the app a little bit, and I wasn't familiar with it. And one of the things that I found is that it's kind of pushes an app that is not for like a random household. It's pushed for an app of people really living paycheck to paycheck. The APR data that I found was a bit higher, and I agree with you that the tip stuff is minor when you look at it in like nominal terms or like in levels. But there was this study from the Center for Responsible Lending claiming that these apps were actually charging an APR that wasn't that different from the payday lenders. So probably if you think about the type of people who is downloading this app, is someone who is very liquidity constrained, has no money in the bank or in cash, has some self-control problems, maybe they're facing some unexpected shocks and so on and so forth. So this is clearly not a representative sample. In the paper, they do acknowledge that. They write that the typical wedge sizes we estimate are most likely an upper bound for the broader population of low liquidity but middle income US residents. What I think you could do instead is try to embrace that this is a particular sample and try to do something to extrapolate to a more representative sample. So you have a lot of data on the characteristics of these households. You have the same data for the general population. So you could do some reweighting analysis to try to understand a little bit what the distribution would look like for a representative household in the US. And in particular, I didn't see anything about this data, so I don't know if you have access to it. But from reading about the app online, what I found out is that there seems to be a lot of heterogeneity in terms of the intensity of the use. Some people say that, okay, I used it like once or twice when I really need the money, but other than that, I don't use it. Whereas other people tell you that they use it multiple times a week. So they're literally like, getting money a day ahead of like when they get the paycheck and so on and so forth, if they get it like multiple times a week and so on and so forth. So one thing that you could do is, if that's like the special selection variable, people who really are desperate for money right now, maybe you could leverage that variation. You could say, hey, let me put people in bins, the heavy users and the low users, and let's do reweighting analysis to try to get something more representative of the low users rather than the heavy users, who maybe the ones for which these biases are like off the chart. The second measurement thing that I wanted to bring up is the measurement error. So this is the formula for the wedge. This is the optimal consumption. This is the actual consumption. And this is just what comes out of the Euler equation. Let's take an individual at the point in time where this wedge is negative. So these individuals, according to the current interpretation of the paper, are consuming less than optimal, are under consuming. You could do an alternative interpretation with measurement error, which is the following. Well, actually, the household is consuming perfectly optimal, only that this number that you're putting here is underestimating the actual consumption by 10%. Okay, you have some measure which is noisy of consumption. It happens to be 10% lower than the truth. You could do the similar argument for any of the other components. So for example, you could say, hey, actually what's going on is that the income that you're measuring underestimates the outcome income by some percent. Or here there's a typo, this should be overestimate, that the expectations are exaggerated relative to the true expectations that these individuals have by 5% or 10% or whatever number can get you closer to the ways that you find. So in terms of measurement error, I've been working with subjective data for the longest time, so I can tell you that they are very noisy. Psychologists in particular have done a lot of work over the last 50 years trying to document that. So if you think of, for example, inflation expectations, there are a million ways in which you ask those questions. If you take someone who does research on inflation, probably they're going to give you the same number every time. However, the general population tends to be, very sensitive to the way in which you ask the question, and even simple things like, for example, are you giving them a slider to pick the the inflation expectations? Are you giving them an open-ended number, and so on and so forth? So we know from that rich literature that this coming from a lot of noise. Maybe in the back of the head, if you could like go into someone's brain and look at the arrangement of the neurons, maybe there is something like their true expectations or whatever. But whatever people are telling us, or the numbers that they're spitting out in surveys, there are some like very noisy measure of that. So even if you were to use the same question, let's say that you are using the perfect question to elicit inflation expectations, even in that case, when you ask the same question twice, let's say today and tomorrow, people tend to give you different answers. The test-retest correlation is something like 0.5. And when you think about the consumption measurement error, which is the one that I will be most worried about, like in the first example that I gave you, yet it is true this is transaction data, so it doesn't have the same noise that typically comes with survey data, but you could imagine of a host of factors for why the consumption or the spending that they measure may be different from the actual consumption of individuals. So the first one is spending is not the same as consumption, and there is a very large literature, about that. So the durable versus non-durable is a big challenge. People, for example, working in development economics, trying to figure out whether some countries are richer than others, are thinking about that all the time. There is not a perfect solution for that. Even if you do your best effort, most likely there's going to be a lot of noise left behind. If you think about people, having income in cash and some making some transactions in cash for these poorer households, maybe a big chunk of what they do, that's going to be missing out from the data. People may have other accounts that they don't match to these apps, so maybe you're missing out on that. And I couldn't see discussion on like the household size, so I wasn't sure what to say about this. But if these are households that have spouses and they have kids and so on and so forth, well, only one person has to connect to the app, so you may be missing out on a lot of the household consumption. You are just observing the consumption that was spent with a credit card of that individual. That may be half or 20% of the entire consumption of the household. So the correct approach is for the subjective data, for expectations data, to restrict to some subgroups for which you would expect the measurement error is lower. I didn't find that entirely persuasive, and that's not the typical approach in the literature. Typically, we do those type of exercises mostly when you're thinking about outliers. But they already winsorizing beliefs and so on and so forth, so I thought that was already taken care of. And then, the other exercise of adding a bit of noise, that felt a little bit subjective. So what they do is they add like a 1 percentage point, a noise with a 1 percentage point standard deviation. Based on what I said before about measurement error, maybe I would do the same exercise with 20 percentage point. The other issue is that, they're adding noise rather than removing it, which is what you would need to do. So the alternative approach I would suggest is to fully embrace the measurement error, measure the measurement error, and try to account for it, a la Bayesian shrinkage. So just to give one example, so what you're doing is measuring the wedge, where in reality you don't have C over here, you have C plus E, where this is some measurement error for consumption. And then what you really want is this wedge, where it doesn't have that noise in. If you think about what this noise is doing to the distribution of wedges, it's just adding noise, so it's just increasing the variance. So what you need to do is you need to shrink the distribution of your observed to try to get closer to the actual dispersion absent of measurement error. So all that you really need to do is to come up with parameters that represent the variance of the measurement error, and there are some data-driven ways in which you could do that. I suggest one, but probably there are much better other ones. So for example, if you have two alternative measures of consumption, in the survey you ask people, hey, what's your total expenditures this month? And then you look at the correlation of that with administrative data. You could, make the argument for why that gives you a sense of how noisy the measures may be. Or maybe there are other studies that use transaction data to proxy for consumption, and they came up with their own, estimates of what the measurement error looks like, and you can just borrow those numbers from those other studies. For expectations, you have a little bit of a panel structure, indeed, that some people responded to the follow-up survey, to the second survey. So you can use the test-retest correlation to measure measurement error and account for it. You can also leverage some test-retest correlations reporting in other studies or expectations, even if they didn't use the exact questions that you're using. You could collect, more survey data, asking the question twice to try to measure it more precisely. Or the one thing that I thought that it was super cool is that they have at the appendix one figure that wasn't discussed in the paper. So my best guess is that you're probably writing that section as you speak, where you compute the wedge for 1 year, and then you compute the wedge again for the people who responded to the survey twice. And that's amazing. And, there may be many reasons for why the wedges are not going to be perfectly the same. It could be, as you said before, that the liquidity constraint was binding in one period, but not in the next period. But maybe what you can do is you can take a conservative approach and say, hey, any inconsistencies in the wedges over time that I find, I'm going to blame it on measurement error. And let's see what's the type of shrinkage that I should do under that assumption. Probably the truth is somewhere in the middle. But I thought that was a very simple exercise that you could do to get closer to the actual distributions of these wedges. And finally, preference heterogeneity. Again, there is a lot of research showing that things like the discount rate or risk aversions are very heterogeneous across individuals. So what you could do is you could just borrow the estimates from those studies. They say that they use survey data to measure the discount rate and just say, hey, they say that it's distributed between these and these numbers. So rather than plugging one number for a representative agent, I'm going to integrate over this distribution that I take from that other paper, and that's the end of it. So to conclude, it's an excellent study. I'm looking forward to reading the next version. Thank you.